Well, welcome back. In the last video that we produced, we talked about the various kinds of financial assets. The two major kinds would be loanership investments and ownership investments. What we want to do now is we're going to focus in on loanership investments. So when you're actually making a loan to a trust company or bank or financial institution or to a government body, really when you set up a bank account, a savings account, a checking account, buy a term deposit or GIC, or buy a government bond, you're making a loan, you're extending a loan to those organizations. And so we'll talk about the types in a second. Now, why would we have loanership investments in our portfolio? Well, one of the main reasons is we're trying to be conservative or cautious with our portfolio. We don't want to experience very much market fluctuation at all. And so loanership investments really are ideally suited for circumstances where maybe we're saving for a specific expense coming up in the next few months or maybe the next 3 years. Maybe we're saving for a down payment on a house. For retirees, it might be to produce regular, consistent income from the portfolio to supplement pensions. It could, for some retirees who don't have pension plans, having regular investments that are coming due that are available to use as income to supplement cash flow. And so it really is an investment that has to be secure, it has to be safe, it has to be predictable, and that's why investors will use these kinds of investments. When you're building a portfolio, one of the aspects of portfolio building is trying to find an overall risk attached to that account that's consistent with the investor's goals and attitudes around investing. And to the extent that investors are increasingly more conservative, they'll have more loanership investments in their portfolio. When we talk about loanership investments or conservative investing, one of the rules of thumb that sometimes gets used out there is take your age, or 100, minus your current age, and that will confirm for you, at least at a beginning point in the discussion, how much loanership investing you should have. So if you're 50 today, so you're 50 years of age, then you should have around 50% of your portfolio in loanership investments. And so that rule of thumb predicts that as we get older, we'll have more loanership in the portfolio. Now, keep in mind that's a rule of thumb. It's very important that when you sit down with your advisor, your consultant, an actuary, your financial planner, that they really work through your numbers when you're planning out your finances to confirm specifically for you what degree of loanership investments you need to have in your portfolio. So it is situational specific, but rules of thumb are good in terms of the initial starting point in the discussions. Now, what are the types of loanership investments that are out there? One of the most common types of loanership investments would be a savings account. Now, a savings account is for the bank or trust company or credit union, whatever financial institution that you're dealing with. A savings account or a checking account is going to pay the lowest rate of interest. And the reason for that is, keep in mind that loanership investments, they are loans to the financial institution. So if that financial institution, you have a savings account with them, they're paying you an interest rate, it is a demand loan. So literally, you can walk into the financial institution, get all your money back at any time. Well, that really limits the kind of investing that the financial institution can initiate on that account. But keep in mind that most institutions, the way they make their money is the difference between what they're going to pay you and what they can reinvest at. The traditional thing that we think about with institutions is that if I bought another kind of investment, which I'll talk about, a term deposit, or a GIC, a guaranteed investment certificate, if they're prepared to pay me on the GIC 2%, they're going to have an expectation that maybe they can reinvest and make 4% on the money. So the delta, the difference between the 4 that they're going to make and the 2% that they're going to pay me, is their profit. So that's their margin. Now, there's different ways that financial institutions make money, but that's one way. So the difference between what they pay you and what they can reinvest at. So we have savings accounts, that's a demand loan. We have term deposits or GICs. The difference there was with a term deposit or a guaranteed investment certificate, you're now beginning to commit your money longer term. It's going to be maybe a 1-year term or a 2-year term or a 3-year term. or a 5-year term. And so what you're going to do is you'll take your $10,000, and let's say they're prepared to pay you 3% for 5 years. You know that every year you're going to get $300 paid to you as interest, and then at the end of that 5 years, you're going to get back your $10,000. Now, again, in this particular circumstance, the institution knows you have 3 years or 5 years to work with, and so they can go a little bit longer term in their approach to investing, hopefully get a little bit more yield, and they'll pay you 3% for the use of that capital. With this traditional GIC or term deposit, you do not normally have access to the capital, so it's locked away. So you're giving up control, flexibility, liquidity. So liquidity, to get that money quickly, you're giving that up for a little bit more yield in this particular circumstance. So again, we've got savings accounts, which would be a demand loan to the financial institution. We've got term deposits and GICs, where you're locking up for a period of time to get a slightly higher yield, and the financial institution makes the money basically on the spread between what they pay you and what they think they can earn on the money that they've received from you. Now, another category would be traditional bonds. Now, bonds, what we think about typically with government bonds would be federal bonds, so federal government. That's the highest credit quality bonds out there, so AAA. And the higher the credit quality, the lower the interest rate that institution or government has to pay you. You have provincial bonds. We have municipal bonds. We have corporate bonds. And with all these bonds, again, at one level they function much like the term deposit or GIC. Now, in a follow-up video, we're going to talk about how bonds are priced in what's called the bond market. But for now, let's assume that we go out, we talk to our financial planner or our stockbroker or our investment dealer, our bank, and we buy an individual bond. Typically, to do that directly, we have to set up a brokerage account, and then our advisor will help us facilitate a trade to get that bond. Now, with each of these bonds, we can buy the bond, and we can have what's called a face amount of the bond. So in my discussion here, we'll call it $10,000, and that's the face amount. And we're going to have a coupon rate. And the coupon rate on a bond is going to be basically the interest rate. Typically, that coupon or the interest rate is paid semi-annual. So you're going to get a couple of payments a year. And then we're going to have the maturity date. And let's say that our bond is a 10-year bond. So with a bond, again, we've got federal bonds, provincial bonds, municipal bonds, which would be city bonds, floating bonds for infrastructure, sewer, roads, that kind of thing. And we have corporate bonds. So insurance companies, the banks, large energy companies, companies all the time are taking money, receiving money from investors as a loan, and that's called a corporate debenture, and then they raise capital that way. And so we have the face amount of the bond, which is going to be the maturity amount in 10 years. So we pay $10,000. In 10 years, we get $10,000 back. We have a coupon rate, which is the interest rate. It's paid semi-annually. And so every year we'll get, on that coupon, again, assume that's 3%, we'll get $300 a year in 2 payments of $150. And like I said, we get this back at maturity. Now, as we go down this list, depending on different countries have different bond ratings, different provinces do, certainly different municipal governments have different bond ratings, and different corporations have different bond ratings. And depending on the bond rating, you might be able to get higher rates of interest on these investments. I'll talk about in another video the risks that you might take on and how you protect yourself against those risks by buying lower credit quality bonds. But suffice it to say, you can get a little bit more yield by going down this continuum. That's the basic mix. There are other things like mortgage-backed securities and other investments, but for the purposes of our presentation, we'll just be focusing on this area. So again, just to summarize, Different kinds of bonds will give you different interest rates often depending on the credit quality. You've got the face amount of the bond, it matures at $10,000. We have the coupon rate paid semi-annually, and we have that maturity date. So in the next presentation, we're going to talk about the different guarantees that investors have when they buy bonds.